we have our returning champion guest coming back to the pod. I'm his favorite son, I think, but Len can confirm that for us. The founder and the CEO of the Green Group, Len Green. Welcome back, my dude.
Man, I got to tell you, each time I come back, your audience keeps on getting bigger and bigger.
I mean, yeah, it must be you. It must be the power of the Green Group. I hope the clients are building in the same fashion. Let's get into it. We're getting towards the end of the year. I got a lot of people at West Point. One of the first questions they asked me are, what are the tax benefits of joining a partnership? And, we've covered this a little bit, but I think if I remember correctly, it depends on how the business is classified, whether it's a hobby, whether it's passive, whether it's active. Can you just explain that to the people and what the different benefits are depending on how your horse involvement is classified?
I certainly will, Joe. And I've had a number of podcasts lately, West Point and TaylorMade and Toba and horse-related charities. So there's a whole bunch of questions that are varied, but there's a whole bunch of questions that are right down the middle. And probably the most asked is, if I'm involved in the horse business, what difference does it make whether it's a hobby or it's considered passive or active? And the answer is all the difference in the world. If it's a hobby, the income still has to be picked up, but the deductions are not allowed. If it's passive, well, you'd say, well, okay, my deductions are still allowed. Yeah, but only against passive income. Well, that's okay, Len. I have dividends, interest, capital gains. No, those are called investment income. Those are not passive income. So you need passive income to deduct passive losses, and most people do not have that. So now, number one, the hobby is the worst. Passive is second worst. I see so many tax returns that say passive loss carryover not used in prior years. That's crazy. And then active. Well, then I hear all kinds of stories about how active you have to be, and you have to have profits, and you have to have 500 hours, and all misconceptions. So I think later on, as we go through this thing, I will point out to you what you should be doing to be active, okay? Also, Joe, I want to go over with you the fact that Biden hired a truckload of IRS agents because he said there's got to be gold in looking at everyone who has big losses in the horse business. So again, make believe you were being examined, okay, because you're a high income bracket person. Okay. And the first thing the agent would say to you is, Joe, are you enjoying the game? And you would say, well, yeah, it's a good game. Good game. Great. And Joe, now that you're married, okay, you're looking at things for growth. So again, are you in this game, okay, because you expect to make money, or are you in this game to meet people and have fun? And you might say, well, meet people and have fun, I guess a little bit. Okay. And then they'd ask you, do you have a separate bank account and you're running this thing in a business-like manner? Nah, it's not big enough to do that. I draw my checks to West Point out of my regular account. Okay. Then they say, do you have a business plan or strategy? Well, yeah, I know what I'm doing as far as trying to win. And that's why I joined West Point. Okay. When you look the whole thing around, the agents got you by the short strokes. Okay, because you haven't done the things that people have to do to prove this is an active business. Do you have an advisory team? Well, most people don't have an advisor. They have an accountant or a lawyer or an agent who represents buyers and sellers. That's not independent. So again, what West Point gives you is, number one, you have an opportunity to get horses at the highest level. 2, you get great jockeys. 3, you know that Terry and the gang are buying horses, okay, through people, and they're independent in the sense of buying them, okay. You're not representing the buyer and the seller. And because of the fact that you have sessions for networking and things, people have another reason for joining in. So again, you're doing it right. Now, if you keep on having winners like you had a couple of weekends ago, you won't have enough horses to fill it with. But again, it's part of the success. If you at least hit it with a good horse with well breeding, you got an opportunity to make a heck of a lot of money.
And Joe, one of Dad's other favorite topics to talk about is depreciation, which is right up there. If you did hashtag depreciation, I'm sure it'd be one of the most popular looks on Google these days. So much so that he's going to tell you, Joe, that if you buy a horse at the November sale or you buy a horse privately before year end, that you can have special allocation and depreciate it. And he is a firm believer in it, so much so that he made sure that when my sisters and I were born, that we were all born before year end. That way we would count towards the current tax year, even though, my birthday's a week before New Year's. So that is putting, policy into practice as far as I'm concerned. Talk to us a little bit about depreciation of horses and if it still makes sense to buy horses here, Thanksgiving and December of 2024.
Again, John, great question. Most accountants will tell you if you buy it in November, you get 2 months depreciation. They'll also tell you that if you buy a horse, okay, and the Internal Revenue Code says it has to be put in use, well, that means racing. Bzzz. No, it doesn't mean racing. Putting it in training, okay, qualifies it to take the depreciation this year. You don't have to even pay for it. As long as you sign the slip, you can take depreciation on it. And you don't take 2 months, you take special allocation, and you can write it off almost entirely in the year you buy it. And if you buy a mare in foal, there's some extra deductions you can get for the in foal uterus. Now, again, you'd say, well, Len, doesn't everybody know this? I'm supposed to be a tax expert. And yet when it comes to pensions, okay, I know the simple things about profit sharing and pension plans and IRAs and SEPs and KEO. But boy, oh boy, I need an expert if I'm going into weighted average, early retirement, or combination plans. Well, the same thing happens with estate planning. I know the basics, but I don't know about grits, grats, generation skipping. Well, I don't expect normal accountants to know all the special rules on horses, but I do, because we obviously have horses in every category. Mares, okay, yearlings, weanlings. Also, we have farms. So the normal thing for an accountant to look at a farm and say, okay, structure according to the IRS tables, 20 years. But that they don't look at the small print that says special purpose buildings, such as barns, which gives you a write-off in 1 year. Okay, how about land? I see so many tax returns where land is a huge number. Land is not depreciable. If you look at it under the microscope, though, the land includes roadways, fences, paddocks, trees, all of which are tax deductible if you read the small print. But you wouldn't read the small print if that's not your specialty.
That's why we come to you to give us the small print and break it down for us. There's another question I got from a prospective West Point partner recently, just in terms of business expenses. Like if he buys into a horse and he drives up to Saratoga, he stays there for the weekend, like, is there a way to claim some of those expenses as part of your business? Like, I think it probably goes back to whether or not you're an active investor or a passive investor. But yeah, just give us like the layman's explanation of whether or not, if you own horses, you can claim business expenses when you go to see them race.
Gee, Joe, I was going to. That's a great question, and I expected you to ask a question like, I have that question, and I have one more question. I got married this year. Number one, is that a casualty loss disaster? Or two,
for her it is.
He set him up for that one.
Or can I write off some of the expenses for people I entertain who are part of the horse community? But the first question that you asked is really, if I had to classify the number one deduction that most people miss, it's that deduction that you brought up. And they say, well, I see my K1 from West Point, and it gives me my loss. And I'm assuming that I can treat it as business because I've had the 100 hours between, okay, the sessions and going to the sales and going to watch the races. Okay? But can I take these deductions for going up there? And the answer is yes, you can. But Len, I know that business deductions are not deductible normally but it is if you have a partnership, okay? And there are ways of picking them up on the tax return. But yes, You can deduct going to sales, going to the races, okay, going to meetings. Okay. It's a big missed deduction. Home office expense. I mean, it's all there. Now, again, it pays to have an opportunity to make money, and let's not gloss over this passive versus active versus hobby, because when you join a partnership, you have the opportunity, the strategy that if you hit, you can hit really big, and that's all it takes is one big year out of 10 or 15, and you're still going to be okay.
One final question for me, and that involves independent contractors. We're constantly using what I would call a one-off individual. Somebody, when we ship horses to the Breeders' Cup, we used a new blacksmith out there. When we ship horses to Canada, it's a different vet than what we use normally in Ocala. When we go to a sale, we use independent contractors to shortlist for us or to vet out horses for us. So if the professionals on the other end are independent contractors, does that diminish the ability for them to take deductions, or is that an opportunity for them?
It's an opportunity for them. Let's go through it in a couple of different steps. There was a big push, okay, by the IRS, very successful, okay, against trainers who said, hey, every one of these people, okay, are really employees of you, not independent contractors, and therefore you're subject to Social Security, unemployment, et cetera, kind of thing. And they won a number of big cases, as you remember, against very big name trainers who got hit for large fines. I mean, so much so that Karen McLaughlin, okay, stopped training because it was so horrendous. But from the payer's point of view and from the person receiving it, it is really very advantageous for them to be independent contractors, because if they are, they can deduct against it home office expenses, automobile, medical, etc. But they can't be working just for you. If they're working for a number of people, then they qualify as independent, and then 100% of your payment to them, John, is 100% deductible, and you don't have to worry about those other things.
And from their standpoint, that allows them then to put more money into retirement accounts and things like that if they're independent?
Absolutely correct. Not only retirement, John, but also take their automobile, their home office, okay, their travel to and from, which they couldn't do if they're an employee.
Last question for me. It's a personal one. You were honored this summer at the Racetrack Chaplaincy brunch at Saratoga. It looks like it was a beautiful event. I'm sorry I wasn't able to make it, but I was there in spirit with the video, and I heard that was a big hit. Certainly you're a very deserving honoree. Just what was that day like, after pouring your heart and soul and obviously a lot of money into the business over the years, to have so many people there to celebrate you and your contributions to the industry?
Well, thank you, Joe. It was one of the highlights. I mean, I've been fortunate that I've been honored a number of times by a number of different organizations. Terry Finley, okay, who's a real good friend, okay, told me that he had been honored and he raised a record $200,000, even though the budget was about $100,000. And my response to Terry and to Chaplain was, if Terry could do that, I could do more. Now, again, when it came out, the fact that we raised more than $400,000, what that means, though, is not a pat in the back for Lynn. Okay, as I told the chaplain who said, "How did you do it?" I said it was easy. I told my clients I'd turn them into the IRS if they didn't support me. But when I saw what the money could be used for, instead of chicken once a week, we could have meat and fish every single time. Instead of backpacks for just kids of a certain age, we could have backpacks for all of them. We could have sneakers for everybody. We could have more money that goes into the summer camp. They run a wonderful program there, and I encourage more and more people to do it. But it was really great to have John get up there, introduce me, and not tell bad jokes about me. Okay, it was nice to be able to beat Terry But more importantly, it was nice to bring the attention to something that's really, really worthwhile. Now, was the fact that we won the Breeders' Cup a couple times, okay, exciting. Yeah, but John's got to win it a couple more times before he gets to be, the top dog in this family, right?
All right, Len, thank you so much for stopping by. Always valuable insight. And don't forget, there's a complimentary confidential half-hour consultation for listeners of Rail Talk. Just call Len up at, what's that number, Michael?
732-634-5100.
Or go to greenco.com. Len, thank you so much for the time and the insight, my friend.
Thank you, guys. Keep up with the great work, okay?